Let's take a look at Chapter 2. We'll get into a little bit more specific things about finance now. And you can see this week we'll talk about financial statements, cash flows, and taxes. So those are the big picture topics. As I mentioned in Chapter 1, we'll usually start out with this slide, and then we'll just kind of do a deeper dive into one particular part of this slide. You can see the arrows pointing at free cash flows. So what they like to do is just kind of give us an example in the PowerPoints. And they also give you an example in the chapter. The PowerPoint ones are a little bit more simpler and more condensed. But it's always good to review the examples they gave us in the chapter also. So this is Computron. They expanded operations in 19. The following slides show key information and financial statements to evaluate the expansion. So in 18 and 19, so 19 represented the expansion year, and unfortunately you can see the stock price went down. You can see that the shares didn't change, the dividends went down, tax rate's the same, and the cost of capital is the same. Take a look at their income statement. Revenues less expenses. So revenues, you can see sales went up, that's good. Cost of goods sold though went up at the exact same amount. Everybody recognize that? This is in millions, so this is 5,500,000. Well, my sales and cost of goods sold both increased by 500,000, so that's actually not so good. If sales go up, I don't want cost of goods sold to go up at the exact same amount. That's not good. So depreciation goes up, other expenses go up. My EBIT, which is earnings before interest and tax, then goes down. My interest expense goes up, which means I probably borrowed some money. And then you can see I have less pre-tax earnings. I have taxes here, and my net income is lower than the previous year. Okay, so while sales went up, my expenses went up in a higher ratio than my sales did, and so therefore I have now lost money. Okay, and this is 500 million, not 500,000. So 9% growth, which is good. But interest went up a lot, and net income fell by a lot because we must have borrowed some money, and we'll figure that out by looking at the balance sheet. So this is the asset side of the balance sheet. So cash went down, short-term investments went way down, receivables went up. Well, sales go up, so it makes sense that receivables would go up to some degree. Inventory goes up, which again is legitimate because sales go up, but should they have gone up by this amount? Probably not. So my total current asset goes up. My gross fixed asset went up. That tells me that we went and bought some property, plant, and equipment because we went from 3.9 to 4.8. So we definitely increased there. So net fixed asset goes up quite a bit and total asset goes up. So it says here, what's the effect of the expansion on assets? Well, current asset, net fixed asset both went up. AR and inventory, though, really went up a lot. So it tells us we're taking longer to collect from our sales. And it also tells us that we have a lot of unsold products or unused raw materials. We don't know if this is a merchandiser or a manufacturer. We just have too much inventory. Sales went up, so inventory should go up, but not in the amount that they gave us. And then this is the liability and equity side. My payables goes up. Notes payable is a $200 million increase. So I borrowed money. Accruals goes up. Long-term debt goes up by $300 million. So you can see what they did is they took out some extra notes payable and some long-term debt to finance the expansion that they did. So what effect did the expansion have on liabilities and equity? The debt increase is what financed the expansion, and the company did not issue stock because the common stock did not change. Retained earnings did go up because they did have net income, just not as much net income as the previous year. And then we look at the cash flow statement, and cash flows are always organized into 4 categories. Cash flow from operations, cash flow from investing, and cash flow from financing. And ideally, your cash flow from operations is positive, which it is. Our net income adjusted for non-cash items. So remember that net income, it includes accruals and non-cash items. And the goal is to take the GAAP net income number and break it down and get it down to a pure cash number. So the actual cash that this company generated by doing what it does We don't know what it does for sure if it's a manufacturer or a retailer, but it generated $404 million worth of cash. And that's good. It should be positive. We do want that to be positive. Okay. Then investing is money used to acquire long-term assets. And so we went and we invested in $920 million worth of property, plant, and equipment. So that's negative. Usually for most companies, this is negative, this number. Then we have the financing, and this represents money borrowed or money paid back. And so we were a net borrower. We borrowed $500 million, and we did pay some dividends, so that's a deduction here. So net cash provided by financing is a positive because we borrowed money. And we borrowed money so that we could invest in property, plant, and equipment. So basically, this $400 million number here really went to paying for a good chunk of this $830 million right here. Okay, and then we put it all together, and so my net change in cash was a decrease by 10 million. So I had 60, now I got 50 at a net decrease of 10. So to finance that $830 million worth of property, plant, and equipment, I used some of my own cash that I generated. I borrowed some money. I took that and I invested that into property, plant, and equipment. Okay, so it kind of just tells us that. I kind of already mentioned a few of these things right here, and but ultimately cash fell. And then what is free cash flow and why is it important? We talked about this in chapter 1. It's the amount of cash available from operations that can then be given back to shareholders or used to repay debt and have the company still maintain current capacity, current operations. And so what can free cash flow be used for? Pay back interest on debt, pay back principal on debt, give the money back to shareholders through a combination of dividends and buying stock back. Or we can just use that to plow it back into the business, and we can invest, we can buy marketable securities, investments, and things like that. Okay, so this is actually the nuts and bolts, the gory details of computing free cash flow, and you can see it right here. So you might want to just remember this is slide 18. Obviously, it's in your chapter also, but this would be a good slide to look at to help you remember. Here is how I go through that process of computing cash flows, because you will do this for your homework. Okay, so you have to go figure out what your net operating profits are, step 1. Step 2, what's the change in working capital? Step 3, what's the change in operating capital? Step 4, look at the difference between steps 2 and 3, compute that, and then we compare that to step 1 and we get our free cash flow. Okay, so it's not that bad if you just go step by step, and when you do this in your homework, they'll explain what everything is for you. And so we'll get to a few terms here. NOPAT, net operating profit after tax, is basically taking your EBIT times 1 minus the tax rate. The tax rate is 25%. I should point out that the federal tax rate is actually 21% for corporations, and it's a flat tax rate. So no matter what corporations make, they pay 21% at the federal level. The reason they use 25% is just a nice rounded number, and that takes into account the fact that most states have some kind of a corporate income tax. They just use 25 as a nice rounded number. Okay, so there is my NOPAT for 19 was 345. In 18 it was 420, so it went down. You actually would like that number to go up. That'd be the preference. What are operating current assets? Current assets are the current assets needed to support operations. They typically include cash, inventory, and receivables. We typically do not include short-term investments because that's just where a company will park extra cash if it has it, just somewhere in short-term investments so it can easily tap into it if it wants to. But your cash, inventory, and receivables are your operating current assets. Same thing with operating current liabilities is typically your accounts payable and accruals. It does exclude notes payable though, because notes payable is a source of financing and not operations. So you might have a few questions that'll deal with these. What are operating assets and what are operating liabilities? So net operating working capital is your operating current assets, which again are inventory and receivables and cash, minus operating current liabilities, which are notes payable and accruals. Okay, so you looking for those specific items, and the net change is 750 in 19. In 18, the net change was 580. So that 750 is bigger than 18. That's not necessarily good. So it's not necessarily like that's the way we want to do that. Okay, so then we have total net operating capital, also called operating capital. So operating capital is my net operating working capital plus my net fixed assets. And net fixed assets is my gross fixed assets minus depreciation taken. That gets me to doing my free cash flow then, and you can see that we actually had a negative number in 2019. We had negative free cash flow. And the reason we did is we spent a lot of money. Like, we didn't have enough cash flow anyway, and then we went and we bought a bunch of property, plant, equipment with it. So here's how I used up my free cash flow. I had some interest that I paid. I paid some dividends. I sold off some of my short-term investments, but then I went and I spent $500 on debt. Okay, so I put some money back into debt. And then some ratios, so profitability ratios, NOPAT divided by sales, and this tells me the amount of operating profit generated by every dollar of sale. You can see it was 12, now it's 8, and so that went down. That's not good. I want that to actually go up. And then my capital requirements ratio, my operating capital divided by sales. You can see that went from 58 to 70.8. The amount of capital needed to generate sales went up, which means we were not very efficient in using our capital, so that's not good. The return on invested capital is my NOPAT divided by operating capital. Went from 12 to 8. And again, because my profitability went down, that didn't help. And the firm's cost of capital is 10. Did the growth add value? In fact, it did not, because ideally, if you grow your company, you make investments to grow your company, you want that growth rate to be higher than your cost of capital. So my cost of capital was 10, and 18, my ROIC was above 10. That was good. It was 12. 12 is more than 10. But 19 now went down to 8, when again, my cost of capital is 10. So that tells me I'm losing. I always want my ROIC to be above my cost of capital. Okay, and because we had a negative cash flow, that's why it went down. So the investment that we made in our expansion did not work out the way we wanted it to. So WACC, we talked about what that was in chapter 1. It's a weighted average cost of capital. Then we have another concept called EVA, which is economic value added. And that is your NOPAT minus your WACC times your invested capital. And that's just another measurement for performance. Okay, and so that was positive in 19, positive 72, negative 80 in 20. So again, that declined severely also. That number needs to be positive. If it's positive, we've added value back to the firm. Then market value added is the market value of the company minus the book value. Market value is what is the share of a stock worth on the market. Book value is what's the equity of the company. Okay, so we're comparing market value to its common equity. And ideally, market value is more than the book value. And the higher that ratio, the better management has done at adding value to the firm. Okay. So it says here, market value of debt is close to the book value of debt, then MVA is market value of equity minus book value of equity. And that's usually the case. That's usually the way it works out. So it says here, let's do this for our company between the 2 years. So in 18, it was a really nice large number, 2,270,000. In 19, it went down severely because the company lost value. The stock price went way down. And so it just tells us that management did not make good decisions in 19. The last part of the chapter talks about taxes, and I would imagine everybody's aware that back in December of 2017, a new tax law was passed. And in fact, it was the first major comprehensive tax reform since 1986. So 31 years later, and what happens with tax law is every so often, like every 30 years, you have some major revision, and then you have smaller incremental revisions that happen after that. But for the corporate side of things, the old tax rate was progressive for corporations. 35% was the common rate that most corporations paid. But if you didn't make that much, you might have paid a lower tax rate and so on. And they just changed it to be a 21% flat tax for corporations. So no matter what you make, you pay 21%. The goal was to make U.S. corporations more competitive with foreign corporations. Most foreign governments were not taxing corporations as high as the U.S. was. And so that 21% rate is now very comparable to worldwide rates. And the goal was that U.S. companies could compete at the same level as foreign companies and keep more of their income. It says here, interest and dividend income received by corporations. Basically, remember, corporations can invest. They can buy stocks of other companies. They can buy bonds of other companies. And pretty much they just pay 21% of what they receive, except for dividends. The nice thing about corporations, though, is they get a tax break for having dividends. So if I'm a company and I buy stock of another company and I receive dividends, I can exclude 50% of those dividends from taxable income, and the remainder is paid out at 21%. The reason for that, remember that corporations are double taxed. So if I'm a corporation, I take all my revenues minus all my expenses, then I pay a 21% tax. Then I can pay dividends out. And then when I pay dividends, I pay them out with after-tax dollars. My shareholders receive those dividends, and they pay tax again. That's the double tax. So what the government is saying to corporations, because we double tax you, we'll let you exclude from revenues, from taxable revenues, 50% of dividends that you receive from other companies, which were obviously double taxed. So it does give an incentive for corporations to buy stock of other companies because you get a little bit of a tax break for having those dividends. Okay, so that's kind of why that happens. And then also, corporate earnings can be very up and down, right? If you are a salaried employee, you probably pretty much can lock in what you're going to make every year, right? You kind of know. Let's just say you hired at a company making $50,000, and that's your salary. So that's pretty much your income for the year. Next year you might get a cost of living raise, and maybe you get a 3% bump. The year after that you get a promotion, so you're going to get maybe a 6 or 7% bump. And that's pretty much what you can count on. You kind of just say, every year I gain more experience, I become more valuable in my company, I'll make more. And so for individuals, we typically make more as we progress. Corporations, though, it depends on the economy, the competitive environment, regulatory environment. You'd have a year where you make a lot of money, the next year you could lose a lot of money. And so what they did with the law is they allow you to do carrybacks and carry forwards. Now, the old law allowed you to do carrybacks and then refile your taxes to get, and for corporations, to get, you could take a profitable year, and the next year you had a big loss. You can take that loss and go backwards and get a tax refund. Okay, that seems odd, but you could do that under the old law. The new law does not let you do that. So carry forward, but I can carry forward losses. So I can take a loss and use it to offset future profitable years. But I can carry those forward forever. So if I'm a newer company and I've just got loss after loss after loss, I can just let those build up. And when I become profitable, I can take all those losses and begin to apply them against my profits to save me taxes. Okay. And then you can see here dividends paid and interest expense. And as I mentioned, when a company pays dividends to shareholders, it's not deductible. However, interest is. So corporations will often carry debt because they get a tax break. They can take the interest expense that they have and deduct that from earnings and save taxes. Up to a limit. It can only be 30% of EBITDA for 19, 20, 21. Then after that, it becomes 30% of your EBIT after that. And then corporate capital gains and losses. When corporations, capital gains arise when companies sell an asset for more than it paid. Losses are the opposite. Capital gains and losses are treated like other income for corporations. They still pay the 21% on those. And then a little bit about foreign profits earned by overseas subs of U.S. companies were taxed at the sub's legal residence. Ireland maybe because it had favorable laws. Prior to the Tax Cut and Jobs Act, no U.S. taxes were due if reinvested overseas, and U.S. taxes were only due if profits returned to the parent. Which part of the reason the tax law was passed is you had a lot of companies that were making profits overseas, but never reshoring those dollars, never bringing those dollars back to the U.S. because there'd be some very unfavorable tax treatment. So why would I do this? But the law allowed companies to bring that money back to the U.S. and invest it in domestic things in the U.S. So part of the goal was to bring those monies back to the U.S. for companies to invest in U.S. things instead of keeping that money overseas and only benefiting other economies and not the home economy. That's part of what some of these rules are right here that they're talking about. And I talked about this talks about interest and dividends taxes. So assume a company has $87 million of taxable income, $8 million of interest expense, $10 million of dividends, 21% tax rate, and 50% dividend exclusion. How much will it pay in tax? And so you take the taxable dividends received to figure this out. 1 minus the exclusion rate, which is 50%, times the $10 million worth of dividends. So they'll pay tax on $5 million. Taxable income is your operating income plus interest plus taxable dividends. And then you just add that all up, multiply it by 20%, and you're good to go. $21 million. So $100 million worth of earnings, $21 million worth of tax. On the personal side, the law changed a few things on the personal side also. Before and after the law, there still is a progressive tax bracket. There's still 7 brackets under the old law and the new law. Now, the rate of variability between the back brackets increased. That's changed a little bit, and the tax rates dropped. Under the old law, if you're in the highest bracket, you're at 39.6%, and under the new law, the highest bracket is 37%. And it says the rest of the other brackets either decreased or remained the same. So there was no increases. Everything either stayed the same or went down a little bit, just depending on what bracket you happen to be in. And most middle income, if you kind of just said, what's the average taxpayer, middle income America, their bracket's probably in the low 20s, 20 to 25% would be the vast majority of people. Then exemptions. There used to be something called exemptions, and it was per person. So if you had a family of 4, you take 4 times 4,050, and that was an exemption. That just went away. That no longer exists. And now they do what they call the standard deduction. And that did exist before, but they dramatically increased it. So they threw the exemptions out and just said, we'll just give everybody a standard deduction instead. So it almost doubled. It went from 6,350 to 12,000. It's even higher now that we're in 2019. It's even higher. It's higher. And then married filing jointly changed also. Okay, so you can see what that was. So basically the standard deduction went up a lot, which means it's harder to itemize. So the people that will now itemize would be people who have a large home mortgage where you can deduct interest on your home mortgage and property tax, and you are gifting money. Otherwise, most people will probably not itemize. They'll take the standard deduction. So itemized deductions then, it says phased out of itemized deductions as a part of AGI as your AGI increases, and then mortgage interest. And if you have a really expensive house, you can't deduct all the interest either then. So for the wealthy who might own a more expensive house, it's going to be harder to do. Now, imagine you live in San Francisco and you're not necessarily considered wealthy because the cost of living there is so high. Well, an entry-level house there might be $750,000, believe it or not. So it doesn't necessarily help everybody. It depends on where you live. But anyway, so that's just something to think about. And home equity lines of credit are not deductible. Charitable contributions are, with some limits. Most would be, but there's a limit of AGI. 60% is the most. So you can't give all your money away and get a deduction for all of it necessarily. And then on investment income, there's a few changes. Net investment income tax, 3.8% tax on investment income, in addition to other income taxes paid on investment income. but only applies to high-income filers. And you have to be more than $430-some thousand to be considered a high-income filer with these high-income laws kicking in. Dividends, capital gains. Taxpayers do get a favorable tax rate for those. And they did under the old law, and they do under the new law. And there is no cap. It doesn't really depend on. It depends slightly on how much you make, but most are what they call 0, 15, or 20. So if you have dividend income or capital gain income, you pay either 0, 15, or 20% on that. So if you're a high wealth individual and you're paying the 37% tax bracket and you have dividend income, you only pay 20% on that. Most middle income people will pay 15% on that. But remember, I mentioned that middle income America is probably paying a 20 to 25% federal tax rate on your W-2 earnings, but on your dividend earnings, your capital gain earnings, you might pay only 15. Okay. Interest on municipal bonds, municipal debt, has been and still is exempt from federal taxation. So if you buy bonds in the city of Sioux Falls, you do not pay tax on the interest earned at all, no matter what your tax bracket is. And then also keep in mind that there are several business types that are what we call a pass-through. Proprietorships, partnerships, LLCs, S-corps, those businesses themselves don't pay tax. Instead, the owners pay the tax. So whatever income the business has is reported to the owner's personal tax return, and then the owner pays the tax on the personal return. That's the pass-through. The business itself does not pay the tax, unless you are a C Corp, and then C Corps are taxable. Okay. It says here, owners of qualifying businesses may deduct 20% of pass-through income. It's called a QBI, qualified business income. And the purpose of that was to give the same tax break that corporations got to the other types of business forms. Okay, unless you own an accounting firm, a consulting firm, a law firm, or a medical firm, then you don't get the full 20% QBI. You get some of it. It says here it's not available to most. You can get a little bit of it, just not the full amount. But if I'm a retailer and my retail business is set up as a LLC, I get the 20% QBI. The point was to give the same tax break that corporations received to all the other business forms. And then estate taxes and gift taxes. So this deals with taxes on people who are deceased, who create an estate, and then they change some of the rules on that. That's kind of above and beyond the concept of our class, but just be aware some of those laws have changed. So just know that is basically it. And municipal bonds, remember, if I invest in a municipal bond, I do not pay tax on that. If I buy a corporate bond, then I have to pay tax on that. So the reason for that is, think about who issues municipal bonds. It's usually more local governments. The city of Sioux Falls issues them to pay for roads, pay for the Premier Center. School districts issue them to build new schools. It's usually something that involves the public good, infrastructure and things like that. And so because of that, you need people to buy those bonds. An incentive to buy those bonds is I don't pay tax on the interest earned. So a lot of high wealth individuals will buy those. Other investment companies will buy those, life insurance companies, mutual funds, things like that, because you get a tax-free return. Okay, so just kind of want you to be aware of that. This kind of just walks you through what's my indifference rate if I'm looking at if I'm an investor and I'm looking at a corporate bond and I'm looking at a tax-free bond. At what market rate would I want to buy one over the other? And this kind of says, for the example they gave us, 30% would be kind of the number. If tax is greater than 30%, I'd buy tax percent. If tax is under 30%, I'd buy corporate bonds. Okay, so typically high income, high tax bracket people buy municipals, and nobody else does, because you get a better return by owning corporate bonds because your tax rate's lower. That's a general rule of thumb. So a lot of high wealth individuals. So if you hear of high wealth individuals hardly paying any tax, well, it's probably because they put the vast majority of their money into corporate bonds. And what's wrong with that, right? That's the way the tax law is set up. and by them buying corporate bonds municipal bonds, that benefits the public good. That allows schools to build new schools, roads to get built, bridges to get built, infrastructure that benefits the public to get built. So why not? That's my view of it. Okay, so that was chapter 2. Hope that made sense. As always, if you have questions, just let me know.